Welcome to this explainer. Right now, a massive, almost completely silent geopolitical mystery is playing out on the global financial stage. And honestly, it is fascinating. We are tracking a sudden, massive wave of gold being repatriated by central banks all over the world. And we're going to follow those breadcrumbs straight into a high-stakes, sovereign Bitcoin game theory. In this explainer, we're going to examine the shifting behavior of nations, the hidden, frankly terrifying mechanics of government debt, and why the ultimate endgame for central banks might just involve quietly accumulating the world's most famous digital asset. If you've ever wondered how global sovereign debt, giant gold vaults, and Bitcoin are all inextricably linked together, well, you're in the right place. Let's dive right in. So this is the fundamental question we really have to ask ourselves as we look at the macroeconomic data today. What happens when the very people who print the money stop trusting it? You know the old saying, watch what people do, not what they say. Well, if you watch what global central banks are doing right now, they are diversifying away from fiat-based reserve assets at a pace we literally haven't seen in decades. This isn't just some minor, everyday portfolio adjustment by a couple of rogue nations. No, this is a structural, global vote of no confidence in dollar-denominated reserve assets. The macro environment driving this shift includes massive geopolitical fragmentation, rising sanctions risk, and of course, unprecedented fiscal expansion. And as we're going to see, the massive institutions that manage the wealth of entire nations are desperately seeking a safe harbor. Just consider this staggering number for a second: $4 trillion. According to the data, as we approach the start of 2026, the total gold held by central banks globally has reached approximately $4 trillion. Now, why is this specific number so incredibly important? It's because it marks a historic, monumental crossover. Think about this. For the very first time since the Bretton Woods era, central banks collectively hold more value in physical gold than they do in U.S. government debt, which currently sits at roughly $3.9 trillion in those exact same institutional portfolios. Central bank gold purchases have actually exceeded 1,000 tons per year recently. That is a pace with absolutely no modern precedent. So the absolutely crucial takeaway here is that central banks are heavily, aggressively prioritizing a neutral hard asset over the sovereign debt of the world's singular superpower. They're actively choosing the metal over the paper. But where they are putting that metal, well, that tells an even bigger story. For decades, the standard operating procedure for global nations was just to store their gold at the Federal Reserve Bank of New York or the Bank of England. It was unquestioned. It offered deep liquidity, trusted custody, and everybody slept soundly at night. But lately, that logic is being aggressively reconsidered. Take France, for example. The Banque de France recently executed 26 separate transactions, effectively moving 129 tons of gold from New York back home to Paris. And interestingly enough, by utilizing a really clever quality arbitrage between older and modern bars, they managed to book a 12.8 billion euro gain without a single bar ever physically crossing the Atlantic Ocean. Meanwhile, Germany is facing immense mounting domestic pressure to repatriate its 1,236 tons that are currently sitting at the New York Fed. So why the sudden, frantic rush to bring all this gold home? Two words: political risk. When Russian foreign exchange reserves were frozen in 2022, it sent a shockwave through the system. It bluntly demonstrated that assets held in foreign custody can just be seized by a political decision. Every central bank on the planet absorbed that harsh lesson. Because at the end of the day, physical gold held securely in a domestic vault simply cannot be frozen by an executive order from a foreign president. Now, to truly understand this frantic rush to hard assets, we really need to look at the danger lurking underneath the surface of the fiat system. And this brings us to a critical, kind of scary economic concept called fiscal dominance. The sources define fiscal dominance as an economic condition that arises when debts and deficits become so monstrously high that traditional monetary policy completely loses its traction. Essentially, it's a massive trap. When a nation's debt service costs rise beyond a certain critical breaking point, the normal playbook stops working. If you raise interest rates to fight inflation, well, you actually just feed the inflation because you're massively increasing the government's own debt servicing costs. It's a catch-22. This inevitably forces the central bank to provide more monetary financing, which is just a polite way of saying they have to print more money. With the United States debt to GDP ratio currently hovering around 120%, the whole system leans heavily toward continuous currency debasement, just to service those nominal debt obligations. The traditional tools are breaking down. This means your dollars are structurally, mathematically forced to lose their purchasing power over time just to keep the government afloat. And if you look at the macroeconomic data, there is a striking, undeniable divergence happening right now. Emerging markets are actually maintaining fiscal responsibility. They have lower debts, they run surpluses, and they have clearly learned some very hard lessons from the painful debt crises of the 1980s and 90s. But on the flip side, the developed G7 markets, these so-called advanced economies, are sinking into persistent, systemic, deep deficits. So we have a bizarre situation where the deficit-producing developed markets increasingly need financing from the surplus-producing emerging markets. But here is the massive geopolitical rub. These emerging markets are increasingly geopolitical rivals with the developed markets. Why on earth would a surplus nation happily fund the debt of a rival nation, especially when that debt yields a currency that, as we just discussed, is structurally designed to depreciate? They wouldn't, or at least they won't forever. And this stark, undeniable divide is exactly what is driving the urgent, desperate need for a neutral reserve asset that carries zero counterparty risk. Okay, so central banks clearly want a neutral reserve asset. Historically, that's gold. But how do we bridge this massive gap from physical gold to digital gold? Look, central banks love gold because it's neutral, but let's be totally honest here. Moving it is an absolute nightmare. It requires heavily armed convoys, specialized transport, and a whole lot of heavy lifting. It's incredibly slow and arduous to divide, requiring actual smelting and refining. And crucially, as history has shown us time and time again, it is easily seized by physical force during a kinetic conflict. Bitcoin, on the other hand, shares gold's durability and fungibility, but it vastly improves on literally everything else. It is a massive technological upgrade. It is perfectly divisible down to 100 millionth of a single coin. It is instantly portable across the entire globe at the speed of light. And because it is secured by cryptography and a globally decentralized network of computers, it is natively inherently seizure-proof. For nations that are looking to protect their sovereign wealth from both relentless currency debasement and foreign seizure, Bitcoin offers the exact same desirable characteristics as gold, but tailored for the 21st century. To really ground this idea in reality, let's consider the high-stakes situation in Taiwan. As the source material acutely points out, and I'll quote this directly, as opposed to the gold that would almost certainly be seized by invading forces, Bitcoin reserves could be carried electronically to any destination. End quote. Think about the gravity of that. If Taiwan faced a severe blockade or an outright invasion, their physical gold reserves stored in vaults would be immediately stranded and likely seized by the invading force. Furthermore, their US dollar reserves could face sudden restrictions or massive access delays depending on the shifting political climate. But Bitcoin is the only reserve asset that remains fully accessible, completely sovereign, and totally spendable under those extreme worst-case scenarios. It doesn't require physical transport ships or cargo planes. A government in exile could theoretically access its entire national treasury with absolutely nothing more than a memorized seed phrase. This brilliantly highlights why physical gold can suddenly become a massive, heavy liability during kinetic conflicts, and it perfectly illustrates why Bitcoin is emerging as the ultimate sovereign insurance policy in our digital age. So if Bitcoin is this ultimate, untouchable, sovereign insurance, how does the actual transition happen? How do nations move from fiat to Bitcoin? Well, this brings us to a classic, deeply ingrained economic principle called Gresham's Law. Simply put, Gresham's Law states that bad money drives out good. When a population, or in this case, a massive sovereign nation, is presented with two different currencies, human nature dictates they will always spend the one that is depreciating, and they will fiercely, tightly hoard the one that holds its value. Because Bitcoin has a strictly mathematically capped supply of 21 million coins, it is disinflationary by its very nature. There will never be more of it. Fiat currencies, on the other hand, driven by that fiscal dominance we talked about earlier, are inherently structurally inflationary. Therefore, nations and individuals acting completely rationally will naturally spend their rapidly depreciating dollars to fund their daily operations, while simultaneously locking away and fiercely hoarding hard assets like Bitcoin as a long-term savings vehicle. We are already seeing this psychological shift happen on a micro level with retail investors and corporations, and the sources suggest it is now rapidly scaling up to the sovereign nation-state level. And that scaling up to the sovereign level, it isn't just some fringe internet theory anymore. It is actively being legislated right now in the halls of power. Enter the proposed Bitcoin Act of 2024, introduced by U.S. Senators Cynthia Lummis. This legislation explicitly aims to establish a formal, strategic Bitcoin reserve for the United States government. The parameters outlined in the bill are absolutely fascinating. The U.S. would acquire 1 million Bitcoin over a 5-year period. Let that sink in. 1 million Bitcoin. That is roughly 5% of the total global supply, which is a number chosen deliberately to mirror the U.S. government's current 4% share of the world's gold reserves. The scale is incredible. This newly acquired asset would be held in highly secure Department of Treasury vaults with incredibly strict statutory cybersecurity requirements. Crucially, the bill mandates a minimum 20-year holding period. They are treating this strictly as a long-term strategic reserve, not some day trading asset. Senator Lummis has very appropriately dubbed this the potential Louisiana Purchase moment for the digital age, a massive, historic strategic acquisition meant to permanently and fundamentally bolster America's national balance sheet. Now, I know what you might be asking right now. How exactly does a government that is already tens of trillions of dollars in debt afford to just go out and buy tens of billions of dollars worth of Bitcoin, right? Well, the answer lies in a very, very clever accounting mechanism. The proposed legislation suggests funding this massive purchase completely without printing new money. Instead, it relies on diversifying existing funds. Specifically, it involves the Federal Reserve's gold certificates. So currently, the Fed holds gold certificates on its balance sheet that are valued at a statutory price of just $42.22 per ounce. Obviously, that price is from decades ago. By simply revaluing those old certificates to modern current market prices, it instantly creates a paper surplus of over $600 billion. The Treasury can then legally capture this massive accounting gain and use it directly to fund the Bitcoin purchase. It's an incredibly fascinating, borderline genius maneuver. They are literally using the historic massive appreciation of analog gold to fund the accumulation of digital gold. So why go through all of this immense political and legislative effort? Because of the sheer, unadulterated mathematical potential to actually fix the sovereign debt crisis. According to very detailed projections cited in the Presta research analysis, if the U.S. successfully acquires and holds that 1 million Bitcoin for the strictly mandated 20-year period, the resulting capital gains are modeled to potentially pay off half of the entire United States public debt by the year 2051. Half of it. Now, this assumes a historical yet comparatively conservative for Bitcoin compound annual growth rate. In an era where traditional fiscal policy has totally lost its traction and where GDP growth alone mathematically cannot outpace the debt spiral, this strategic asset accumulation isn't just a gimmick. It is currently being evaluated by serious people as one of the most mathematically credible solutions ever proposed to stabilize the US dollar and address the mounting, crushing national debt, all without resorting to catastrophic sovereign default or completely hyperinflating the currency. But here is exactly where the geopolitics gets incredibly intense, because the US isn't operating in a vacuum here. Let's look at the absolute game theory trap that is currently forcing central banks into a rapid global accumulation race. The sources call this concept the reverse bank run. It plays out in 4 distinct steps. Step 1, a single forward-thinking central bank secretly buys Bitcoin. Step 2, because we live in the digital age, the rumor of this purchase inevitably leaks to the global market. Step 3, the realization of this leak triggers a massive prisoner's dilemma, causing rival nations to absolutely panic buy and aggressively accumulate before the strictly capped finite supply of 21 million coins runs out completely. Step 4, this creates an unstoppable massive positive feedback loop converging on a hard money standard, culminating in what monetary theorists call hyper-Bitcoinization, a scenario where the legacy debt-based fiat order essentially collapses into a brand new, mathematically enforced global monetary system. Understanding this intense game theory, the source material reveals a really critical strategic insight, and I want you to really think about this one. Quote, an even smarter play would be for a central bank to purchase Bitcoin without announcing it, allowing it to begin accumulation at lower prices. Think about it from their perspective. If you are a central bank reserve manager and you know for an absolute fact that your very first public official purchase will instantly alert all the other 800 plus central banks in the world to immediately start buying, which would send the price into the absolute stratosphere, your absolute best, most logical move is to operate in complete and total secrecy. You want to quietly build your massive position while the asset is still relatively cheap, long before that reverse bank run becomes public knowledge. The cold, mathematical realities of this global prisoner's dilemma mean that smart, forward-thinking central banks are highly, highly incentivized to be quietly accumulating right now, completely behind closed doors. And honestly, the evidence strongly suggests this isn't just abstract whiteboard theory anymore. The dominoes are already falling and the board is absolutely set. Just look at the nations that are already defecting from the exclusive dollar-dominated system to actively acquire digital bearer assets. El Salvador famously and very publicly adopted Bitcoin as legal tender and currently holds over 7,500 Bitcoin directly in its sovereign treasury. The Kingdom of Bhutan has been quietly utilizing its massive hydroelectric energy resources to mine over 10,000 Bitcoin. Russia, facing massive sanctions, has recently passed legislation officially allowing businesses to use cryptocurrencies in international sanctions-proof trade. And lawmakers in Hong Kong have explicitly and publicly stated they are actively exploring the feasibility of including Bitcoin in their official financial reserves. The intellectual infrastructure for sovereign Bitcoin allocation has definitively been built, and nations are actively moving their pieces on the global chessboard as we speak. So all of this leaves us with the ultimate multi-trillion-dollar question: which major central bank will definitively make the first massive, undeniable public move and officially trigger the reverse bank run? The endgame for sovereign debt seems to be inevitably leading us toward a hard, digital asset reality, and the starting gun for this race may have already been fired in the shadows. I really hope this explainer helped you grasp the profound, world-changing macroeconomic shifts that are happening right beneath our feet. If you found this breakdown valuable and want to stay ahead of the curve, please hit that like button, subscribe to the channel for more deep dives, and most importantly, leave a comment below. I really want to know, do you think your country's central bank is already secretly buying Bitcoin? Let me know your thoughts down in the comments. Thanks so much for joining me, and I'll see you in the next explainer.